In this video, we will go over mortgage markets. We will start talking about mortgages and mortgage-backed securities. A mortgage is a loan that serves the purpose of financing real estate, homes, real property, land, etc. Now, mortgages can also be securitized, as in uh, they create a portfolio of securities where that's an example. And then you can buy pieces of this portfolio like you would buy stocks or shares or even bonds for that matter. And instead of actually buying a mortgage, so you can invest in those mortgages, in other words. Mortgages differ from bonds and stocks, however. Mortgages are always backed by the specific piece of real property. Each mortgage, a mortgage portfolio, will be a securitization of that, and that may have many pieces of real estate. Primary mortgages have no set size or denomination. When we say primary mortgages, we're not talking about when they're securitized. We'll talk about that later. We're talking about just the mortgage, the loan itself. It's whatever value of the property and how much of the property was financed. Primary mortgages generally involved a single investor. A single investor could be an individual buying a home, their residential home, or a business buying a piece of a commercial real estate. Comparatively, little information exists on mortgage borrowers. Primary mortgage market. There are four basic types of mortgages. You have the home mortgages. That is when you buy your home, your residential home, for example, but it doesn't have to be a residential home. You might buy it for as an investment purpose. However, this is what's called a single family mortgage. Then you may hear multifamily dwelling mortgages. These are when you buy apartment complexes, townhomes, townhouses, and condominiums type thing. Commercial mortgages are used to finance the purchase of real estate for business purposes. Farm mortgages are used to finance the purchase of farm. And what happens is the reason these different names, there's different regulations and stipulations on how those mortgages operate according to the type of real estate you're going to buy. Here are some characteristics. As we mentioned, all mortgages are backed by a specific piece of property, so it's collateralized. A down payment is typically part of the deal. Is a portion of the purchase price of the property a financial institution requires the mortgage borrower to pay upfront. Now, notice that the term financial institution is there. Do people get loans and borrow money for real estate without a down payment? Yes, but it might be a private transaction, financed by owner. There are many other ways that this happens, but we are going to focus on the ones that a financial institution like a bank is involved. Then you have private mortgage insurance. So what happens is that typically you will need 20% down to get a mortgage. However, you can get insurance on the mortgage in order to give a lower payment. So you could put less down payment so you can get into the deal now, but then you'll have a monthly payment to pay the insurance in case there's a problem with getting the payments done on time when you had a less of a lower down payment. Then you have federally insured mortgages. Repayment is guaranteed by the FHA or the VA. So this is a different way where you can get a lower down payment than 20% if you qualify. The VA, Veterans Administration, typically for people that served in the military and their family members, but there are other people that serve in government that can also get some benefits similar to this. FHA is for, you don't have to have served somewhere, you just, like say, a first-time home buyer or some other qualifications. A lot of people do qualify for that, and you can go in with a lot less than 20%. And then you get the conventional mortgage. That's the one you typically have to get about 20% down. And those are not insured by the federal government. Now, why do the federal government insure these? they want to promote home ownership. Mortgage characteristics, some more. A mortgage is amortized when the fixed principal and interest payments fully pay off the mortgage by its maturity date. Now, notice here the keyword is fixed interest, fixed principal and interest. Balloon payment mortgages. These are the ones where require fixed monthly interest payment for a 3 to 5 year period, at which point the full payment of the mortgage principal is due. These are more common for commercial deals, and 3 to 5 is typical, but the amount of years could vary. At the end of the day is you're going to be making lower payments up front and then a large payment at the end. Fixed rate mortgages lock in the borrower's interest rate. Therefore, required monthly payments are fixed over the life of the mortgage. So when you have a fixed interest rate, which is the most common one for residential purchases, then you don't have to worry about it changing throughout the how many years you're going to be paying it off. Now, then you have the ARMs, the adjustable rate mortgages. They have interest rates tied to some market interest rate. In other words, that your interest rate may change. Now, and if the interest changes, your monthly payment can change. It can go up or it can go down. Now, required monthly payments can change. And that's what they're trying to tell you, because your interest may change. Then we have more characteristics, the discount points. So discount points, the simplest way to explain that is you can put some more money up front that will lower your monthly payment. Now, this is different than part of the down payment. Typically, this is about buying down interest points. Mortgage contracts generally require the borrower to pay an assortment of fees. This is typical. There's application fee, which includes a processing fee, title search. That's when they have to research the title to make sure there's no other claims or anything that may become a problem once you become the owner. Appraisal fee, that's just what it sounds like. Somebody has to come out and look at the property and assess the value of the property. This is important because when the bank decides the down payment and how much they can lend, it's not just your credit score and your credit history. It's the value of the property will dictate how much they can lend on the property. That will also dictate your down payment. Loan origination fee, closing agent and review fees, etc. So there's all kinds of fees that get paid. It varies. It can vary a lot. Mortgage refinancing occurs when a mortgage borrower takes out a new mortgage and uses the proceeds obtained to pay off the current mortgage. Your typical example is interest rates. Let's say you have a fixed interest rate. The interest rates are lower now. So then you go ahead and take a new loan with a lower interest rate and pay off the other one with a high interest rate. And you now have a lower monthly payment and a lower interest cost. Mortgage amortization. So in the scenario where you have, let's say, a fixed interest rate, which means your payment will be fixed, a fixed amount for the life of the loan. It'll be the same amount every month. Now, it's just the mortgage. We're not talking about insurance and property taxes, which may be part of your monthly payment, but those things can change from year to year. Now, the actual loan itself has an interest rate that is fixed. If it's fixed, then you have a fixed payment. Now, what happens is every month when you write that check or make that payment of whatever the dollar amount is, that doesn't change. Part of that is going to pay for the interest for that month. And the other part is going to go to the actual loan to start bringing it down. Now, what happens at the beginning, because the balance on the loan is higher, most of your payment or a chunk of the payment is going to go just to cover interest, and less is going to go to cover the loan that you actually made. But then as time goes by, it starts shifting where the interest paid is a little less, and then more of your payment goes towards the actual loan itself. And then the amortization table or schedule will show you how your monthly payment is being split between interest and principal, and how that changes, that split changes every month. Other types of mortgages we can talk about are jumbo mortgages, those that exceed the conventional mortgage conforming limits. All it is just a very large amount. Once you pass a number on dollar amount, it is considered a jumbo mortgage. Subprime mortgages are mortgages to borrowers who have weakened credit histories. That's a nice way to say somebody with bad credit, and they go ahead and find a way to fit them into a mortgage, but it's considered subprime. So it comes with higher risk, which in turn may come with a higher interest rate. Then we have the Alt-A mortgages. Risk-wise, so the subprime mortgages we just mentioned are people with really bad credit. Then you got the prime mortgages, which is the people with your normal to good credit, etc. Then Alt-A mortgages are somewhere in between. So they're riskier than prime mortgages, but not as much as subprime. So the interest rate will fall somewhere in between. Now, we spoke about ARM mortgages, which is the adjustable rate, but then we're going to add the word option in front of it. So our adjustable rate mortgages that offer the borrower several monthly payment options. So you can either choose between doing the minimum payment option. In other words, the lowest possible typically is interest only, but could be even lower than that because interest only is a different type of option. However, that's the one that carries the most risk. Now, the most risk for the lender, and the risk for the borrower will be probably losing the property they cannot pay later. Interest only payment. Monthly payments must increase substantially after the initial interest only period lapses. 30-year fully amortizing payment. This is your fix, this is your typical one. You have a fixed amount of money that you pay every month, and then eventually 30 years pays off. The 15 years is the same as a 30-year, except just so it sounds like it's 15 years instead of 30 years. So what happens, you will have a higher monthly payment, but you pay it off earlier. You may also see things called second mortgages. Those are loans secured by a piece of real estate already used to secure a first mortgage. In other words, you have a mortgage for a house, you take another loan on the house. Home equity loans. Let customer borrow on a line of credit secured with a second mortgage on their homes. Now, the word line of credit here, may or may not belong in this situation. One thing is to get a second mortgage that is not necessarily line of credit. The thing is to take a home equity loan where you refinance the property. So it does the same thing as taking out a second mortgage for the equity that you have in the house, except that you refinance the property and then you take cash out. But then it's just only one loan. However, it's still a loan. Now, a line of credit operates a little different. Now, you can do a line of credit on your equity. Those are typically known as HELOCs. However, I want to make a distinction that a second mortgage, a line of credit, or refinancing your home and taking cash out, they may look the same, but they do operate in very different ways. Reverse annuity mortgages. Borrower receives regular monthly payments from a financial institution rather than making them. When the reverse annuity mortgage matures, the borrower sells the property to retire the debt. It's like not the In an oversimplified example or explanation is like the bank is buying the home from you, but you still live in it. And then at the time that you pass away, then the bank now owns the property. They just made you payments while you lived in it. So, secondary mortgage markets. So, a bank or a small financial institution that focuses on lending only, they may start the loan, but what they do is they can sell it to somebody else, and that way they don't have that. So the financial institution would not make as much money as if they were to keep the loan for the, let's say, the 30 years, as an example. However, they remove it from their books and they're able to continue doing business and they collect some of that profit up front. It does lower some risk as well. Now, two ways they can do that: they just grab a bunch of their loans and sell it to somebody. And here you go. And typically the bigger banks buy from the smaller banks, things like that. Or they can do the securitization that we spoke about earlier, where they'll create some kind of portfolio and then they can sell shares in that portfolio, for example, or also the mortgage-backed bonds, for example. Advantages of securitization: the financial institution can reduce their liquidity risk because they trade more, they're easier to trade. Interest rate risk and credit risk. They can generate fee income by selling you those shares and those portfolios they created. A little history and background on those secondary mortgage markets we just spoke about. Mortgage market is unique in that the U.S. government is on purpose involved in developing the secondary markets. Now, earlier we spoke or we mentioned that the federal government insures mortgages to some extent or guarantees them in order to promote home ownership. This is what they're talking about when the government on purpose involved in developing secondary markets to help this process. In 1938, in the United States, the government established the Federal Mortgage Association. You may have heard them as Fannie Mae, to buy mortgages from depository institutions so they could lend to other mortgage borrowers. So what happens is, let's say you have a bank, and the bank is takes so many mortgages or generates so many mortgages. Well, what happens is, as the bank is doing these loans, it ties up the money they can lend out, so that it gets to a point where they can't do anymore. So this organization, their job is to go ahead and buy it from them to release. This is one of the many things they do: buy it from them to release that, and they can continue making mortgage loans to other borrowers, to encourage continued expansion in the housing market and to promote competition to Fannie Mae. Then they also created the Ginnie Mae and Freddie Mac. And so there you go. The United States created a few different, I guess, organizations, associations, in order, with the ultimate goal to promote the housing market, and at the same time promote competition, because as we know, monopolies are a bad thing. Now let's talk about these mortgage-backed securities. So it involves the pooling of a group of mortgages with similar characteristics, the removal of these mortgages from the balance sheet, and the subsequent sale of interests in the mortgage pool to secondary market investors. As we mentioned earlier, they can create a portfolio with mortgages in it, and then they can sell shares in that portfolio. That's one example of how to do it. Mortgage-backed securities allow mortgage issuers to separate the credit risk exposure from the lending process itself. There are three major types of mortgage-backed securities: pass-through security, collateralized mortgage obligation, and then the mortgage-backed bond. Now, outside the United States, synthetic securities, when it comes to mortgages, is more common. Now, the word synthetic, in this case, we're talking about a credit derivative. So the other way to do the securitization of the mortgages was actually the mortgage themselves in a portfolio or the bonds themselves. So when you buy from there, you're actually buying a piece of that. Now, a derivative, you do not buy a piece of that. You're buying like a contract where your money, your value of that contract, the derivative, depends on the value of the underlying asset. Now, that could also be a portfolio. The point is that in this case, you're not buying from the portfolio. You're buying this derivative, uh, which is common in the United States outside the mortgage world. When you talk about options and futures and forwards and all these other contracts that you can get engaged in, where you're not actually buying the asset, but you're buying something that the value derives from the value of the asset. And that's pretty much what goes on here, and it's more common outside the United States. That's it for this video. See you on the next one.